For decades, the label "Made in China" was everywhere. It was on our phones, our clothes, our computers, a symbol of global manufacturing. But look closely at your next purchase. That label might just say, "Made in India" or "Made in Vietnam." A massive global shift is underway, redrawing the world's economic map. What's driving this monumental change, and what does it mean for your wallet and the world? Welcome to the Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Today, we re-unpacking the massive economic forces pulling global supply chains away from China and into the rising hubs of India and Southeast Asia, asterisk, the new era of supply chains, asterisk, we are living in a new era of global supply chains. The system that defined global trade for the past 30 years, a system centered almost entirely on China's manufacturing prowesses fracturing. The reasons are complex, but they began coming into sharp focus during the pandemic. Empty store shelves and year-long waits for cars and electronics revealed the extreme vulnerability of relying on a single manufacturing hub. These post-pandemic disruptions were a wake-up call for corporations worldwide. But the pandemic was only an accelerant. Growing geopolitical tensions, particularly the U.S.-China trade rivalry, had already planted the seeds of doubt. Companies began to realize that putting all their manufacturing eggs in one basket was not just inefficient, it was risky. This has given rise to diversification strategies like the China Plus One model, where companies don't necessarily leave China entirely, but actively build up alternative production capabilities elsewhere. This isn't just a minor adjustment, it's a fundamental rethinking of how the world makes and moves goods, marking the dawn of a new, more decentralized chapter in global trade. Economic drivers behind the shift, so. Why are India and Southeast Asia the prime beneficiaries of this global supply chain shift? The answer lies in a powerful combination of economic incentives. First and foremost is cost efficiency. For years, China's competitive edge was its vast low-cost labor force. However, decades of rapid economic growth have led to a significant rise in Chinese wages. Today, manufacturing labor costs in China are, on average, more than double those in countries like Vietnam and nearly 3 times higher than in India. For companies producing millions of units, this wage differential translates into billions of dollars in savings, making a move financially compelling. But it's not just about cheaper labor. These nations offer access to massive, untapped consumer markets. India, with a population of over 1.4 billion and a rapidly growing middle class, is no longer just a factory, it's a destination market. Similarly, the 10 countries of the Association of Southeast Asian Nations, ASEAN, represent a collective market of over 680 million people. By producing locally, companies can better cater to regional tastes and reduce shipping costs, creating a dual advantage. Governments in the region are aggressively capitalizing on this opportunity. India's production-linked incentive plea scheme, for instance, offers direct financial rewards to companies in sectors like electronics and pharmaceuticals for increasing domestic manufacturing. Vietnam, Thailand, and Indonesia have rolled out their own sets of tax breaks, streamlined regulations, and massive investments in infrastructure, building new ports, highways, and industrial parks to support the influx of foreign investment and improve their ASEAN logistics growth. These coordinated efforts create a powerful economic pull that is hard for global corporations to ignore. Geopolitical and strategic factors. beyond pure economics. The supply chain migration is deeply rooted in geopolitics. The U.S.-China trade war, which began with tariffs and has since escalated into a broader technological and strategic rivalry, has forced companies to reevaluate their geopolitical risk. Operating in China now comes with the uncertainty of potential sanctions, export controls, and political pressure. This has accelerated the search for manufacturing bases in countries that are perceived as more politically stable and strategically aligned with Western interests. This is where the concept of friendshoring comes into play. It's a strategy where countries and companies prioritize sourcing from allies and friendly nations to create more resilient and secure supply chains. India, with its strengthening ties to the United States through alliances like the Quad, is seen as a key strategic partner. Likewise, many nations in Southeast Asia, while officially maintaining neutrality, are keen to counterbalance China's regional dominance and welcome Western investment as a strategic tool. Trade agreements are also playing a crucial role. The Regional Comprehensive Economic Partnership, or CEP, which includes China, Japan, South Korea, Australia, New Zealand, and all 10 ASEAN members, has created the world's largest free trade bloc. This agreement simplifies rules of origin and reduces tariffs, making it easier for a product to be assembled with parts from multiple member countries. This encourages a made-in-ASEAN approach, where different stages of production can be distributed across Vietnam, Thailand, Malaysia, and Indonesia, creating an integrated regional supply network that is less dependent on any single country. Case studies: India and Southeast Asia rising. The theoretical shift is already playing out in the real world, with some of the world's biggest companies leading the charge. Apple is arguably the most high-profile example. For years, the iPhone was synonymous with Chinese manufacturing, but recently, Apple has dramatically ramped up its operations in India. Working with its primary assembler, Foxconn, Apple now manufactures its latest iPhone models in the country, with exports from India soaring. This move diversifies Apple's production away from its massive Guangzhou factory in China, mitigating risks from potential lockdowns or geopolitical flare-ups. In Southeast Asia, Vietnam has emerged as a powerhouse in electronics. Samsung, a longtime investor, now produces the majority of its smartphones in Vietnam, making the country a critical hub in its global operations. The boom in Vietnam's electronics exports is a direct result of companies seeking an alternative to China for assembling everything from earbuds to printers. Meanwhile, Indonesia is positioning itself as a key player in the electric vehicle EV supply chain. With the world's largest reserves of nickel, a critical component in EV batteries, the Indonesian government is leveraging its natural resources to attract major investments from automakers and battery manufacturers. Hyundai has already opened an EV plant there, and other global giants are following suit, aiming to build a complete EV ecosystem from mineral extraction to final assembly. These case studies are not isolated incidents. They are powerful indicators of a broader structural realignment in global manufacturing. Economic implications for the global market. This redistribution of manufacturing capacity carries profound implications for the global economy. For decades, China was the undisputed world's factory. Now we are seeing a more multipolar manufacturing landscape emerge. This shift is reshaping global foreign direct investment (FDI) trends, with capital that once flowed exclusively to China now being redirected to India, Vietnam, Mexico, and other emerging hubs. This redirection of capital is fueling an industrial real estate boom in these regions, with demand for warehouses, factories, and logistics centers skyrocketing. The diversification of supply chains also has the potential to impact global inflation. While moving production can initially increase costs due to inefficiencies and the need for new investments over the long term, a more diversified and resilient network could be less prone to the kind of supply shocks that drove up prices during the pandemic. If a port in one country is shut down, goods can be rerouted from another, creating a more stable supply and, theoretically, more stable prices. However, this transition is not without its challenges. The hyper-efficient, low-cost logistics network built around China cannot be replicated overnight. Building new ports, roads, and rail lines takes time and massive investment. In the short to medium term, the world may face logistical bottlenecks and higher transportation costs as it adjusts to this new, more complex global logistics map. This transition period could see temporary disruptions and price fluctuations as the global market finds its new equilibrium. Challenges and limitations. While the narrative of a shift to India and Southeast Asia is compelling, the transition is fraught with significant challenges. A major hurdle is infrastructure. Many of these nations are still playing catch-up. While investments are pouring in, inadequate ports, unreliable electricity grids, and congested road networks can create serious bottlenecks, eroding the cost advantages of cheaper labor. A factory is only as efficient as the infrastructure that supports it, and in many areas, this remains a work in progress. Another critical issue is the manufacturing skill gap. China has spent decades cultivating a massive, highly skilled, and disciplined manufacturing workforce. Finding millions of workers with the same level of experience and technical expertise in electronics assembly or precision engineering is a monumental task. Companies moving to new regions must invest heavily in training and development to bring their local workforce up to global standards, a process that takes years. Political and regulatory instability also poses a risk. While these countries are currently welcoming foreign investment, changes in government, shifts in policy, or rising nationalist sentiment could alter the business environment unpredictably. Furthermore, there are growing concerns about sustainability in Asia. As manufacturing scales up, so does the pressure on the environment and labor standards. Companies are under increasing scrutiny from consumers and investors to ensure their new supply chains are not only cost-effective, but also ethical and environmentally responsible, adding another layer of complexity to the move. The future of global supply chains. Looking ahead. The future of global supply chains will be defined by decentralization, technology, and political realignment. The era of concentrating production in a single country is over. Instead, we are moving towards a model of regionalized multi-hub networks. A company might have a hub in North America for the Americas, one in Eastern Europe for the European market, and another in Southeast Asia for the Asian market. This local-for-local approach makes supply chains more resilient to global shocks. Technology, particularly AI in supply chains, will play a transformative role. AI-powered analytics will help companies predict disruptions, optimize inventory, and automate production. Robotics and automation will become even more crucial, potentially reducing the reliance on low-cost labor and allowing manufacturing to be located closer to end markets, regardless of local wage levels. The friendshoring trend will likely continue to shape investment decisions as geopolitics becomes just as important as economics in corporate strategy. The world is splitting into economic blocks aligned along geopolitical fault lines, and supply chains will be reconfigured to operate within these new realities. This doesn't mean globalization is dead, but it is being fundamentally redefined from a pursuit of pure efficiency to a more complex balancing act between cost, resilience, and strategic security. Conclusion. The ongoing shift of supply chains from China to India and Southeast Asia is more than just a business trend. It's a seismic event reshaping the global economic order. Driven by a mix of rising costs in China, geopolitical strategy, and the pursuit of new markets, this great migration is creating new winners and losers across the globe. While the path is filled with challenges from infrastructure gaps to skill shortages, the direction of travel is clear. We are heading towards a more decentralized, technologically advanced, and politically conscious system of global production. Understanding this shift is crucial for anyone interested in the future of the global economy. So what do you think is the biggest challenge facing companies moving their supply chains? Will this trend truly diminish China's role as the world's factory? Comment your thoughts below. We'd love to hear your perspective. And if you want to stay ahead of the key economic trends shaping our world, be sure to subscribe for more weekly videos. Thanks for watching.